What is going on, DeRosa Insiders community and everyone watching? This is Matt Faircloth, and welcome to the Cash Flow Digest program. My name is Matt. Our company is called the DeRosa Group, and we are a real estate company dedicated to transforming lives through real estate. It is what we do for those that invest with us on our passive equity investments. It is what we do for those that are students of ours that are learning how to build phenomenal A-plus multifamily operations. Whatever you're trying to do in the multifamily cash flow world, we're here to help you. That's what this program is all about. It's giving you ideas for cash flow, how to build out a real estate business as an active operator or as a passive operator, however you want to do it. That's what we're here for. Guys, I got a phenomenal program ahead of you guys coming up for you guys today. Really good friend of mine is one of our guests. And he's gonna be talking. He owns a lot of different investment vehicles and he's involved in a lot of different things. I really respect this guy, so I can't wait to have him on as a guest. And he's also going to talk to us about probably one of the most unique investment vehicles I've ever heard of that he owns, which are racehorses. So we're going to talk about owning racehorses as an investment vehicle. He's also a multifamily operator, so if we have time, we'll hop into where he sees the market going multifamily-wise and a bit of his origin story and everything like that, and how he was a part of the team that invented that little yellow line that you see on NFL games when they post down the first down marker. Well, that was originally a product, I think, designed by Microsoft, and he was part of the team that developed that, so he can tell you about that too. Looking forward to chatting with my good friend Jay Scott. Before we get there, guys, I want to talk to you about some things going on in the market. Let us hop in here and do a quick market convo, right, guys? There are reports that come out on a quarterly basis. Typically, this one's from Yardi Matrix. And you guys really should plug in to multifamily reports that are out there going on in the world. Let's see if I can grab this link for those of you guys watching live to grab a copy of. There's an interesting trend happening here, okay, that I want you guys to get a look at, and this trend has to do with. Let's see if it goes there. There it is. Okay. This trend has to do with what's happening in the multifamily housing world and where rents are growing and, let's be straight, where they're not, okay? So if you look down here at this chart, you'll see that of all places, rent growth in the United States happening, for the most part, 4.8% in New York City. What? I know. Yell at me. Tell me I'm off. I get it. New York City showing the highest rent growth in the nation right now. Why? Well, there's theories on that, but look at the cities. You probably never heard any of these places. You don't hear the cool kids talking about these places. But the the top 10 markets for rent growth right now: New York City, Columbus, Ohio, Kansas City, New Jersey. Right? New Jersey? What? I know. That's an awful place. You shouldn't invest there, or maybe you should. DC, Chicago, Boston, Detroit, Philly, Indianapolis. Now, don't get too excited, but maybe you should get excited. Here's what's happening. These markets are doing a bit of a catch-up with regards to the suppression that they saw over the last couple of years, because these were your down markets on rent growth on an investment the last couple of years. So there's just a bit of a catch-up happening here. But it also means something. It means that there actually are human beings that want to live in the city of New York City, and they're willing to pay a little bit more rent to live there. So maybe not New York City as an investment place, because New York City is one of those markets where you're either on the inside or you're on the outside. So unless you know that city like the back of your hand and know the rules and know how to, work out the inner workings of the city and the governing bodies that govern that city, I would invest in the city itself. But North Jersey is one of the highest growing rent markets in the country. How about that? Not Austin or whatever. Let's talk about Austin for a second. Talk about Austin, by the way, is shows down not in the top 10. It's down the other side of this list because it's seeing actually rent contraction in Austin. And here's why Austin showing rent contraction. This is completions. This is the number of multifamily assets that are being put online by new builders, people building. Look at that. Charlotte, Austin. These are where you got where the talking heads are telling you should be investing, right? People that are using that BS report from U-Haul on where markets are growing and stuff like that. Charlotte, Austin, Nashville, Raleigh, Orlando, Miami, cool kid town, Denver, Seattle, and, of course, Portland and Seattle. You're not supposed to invest there, of course. But if you look at the number of properties being built in these markets, what is that? Those are all future competitors of yours if you're going to be buying multifamily in those markets, guys. These are companies that are going to be dropping rents, doing concessions, those kinds of things. So yeah, these are markets that are growing. And by the way, here's why. Take a look at job growth. Okay, Austin, Vegas, interestingly, right? Houston, Raleigh, Miami, similar markets, right? These are markets that are showing aggressive job growth. So of course that's why there's people building things there. But guess what? There's a lot of people building things there, and just because that market is showing job growth, it's also a market that's showing you a lot of competition. So that is something that you guys should be considering when you look at markets to invest in. Don't just read the articles on where job growth is and go and try and be one of the other millionth person trying to invest in multifamily in Austin, right? Because it's been there, done that, right? That's what happens in markets. If the talking heads are already talking about it, it's too late. And if the U-Haul report's showing a lot of people are moving there, it's already too late. You've already missed the mark. So what's exciting here, guys, is there's a lot of good data here. By the way, single family rentals. That's where people want to live. So if you're able to landlord on a larger game in single family, maybe that's a way to do it. Maybe doing some scattered site or even some small development or acquisitions, development sites of single family, because they tend to perform like multifamily if you acquire enough of them. Grab a copy of this Yardi Matrix report, guys. Free here on the DeRosa Insiders page here on Facebook. If you guys want to grab a copy of that, just go to facebook.com and look up DeRosa Insiders. It is a free community for those that want to learn and grow alongside us. That is there on Facebook. So go check that out. That's what I got, guys, for today's current event moment. I hope you guys enjoyed it. Please let me know your thoughts in the comments on Spotify or on YouTube when you guys check out this video. Love to hear what you guys say. Now, as I work out my tech here to get that screen share thing away. Pause. Let's see. There we go. All right. Okay, guys, we're going to talk a little bit about this guest. This is a phenomenal guest that I didn't know growing up, but we grew up about, I don't know, maybe a half mile from each other. And that just kind of one of those weird things, kind of grew up in the same environment. Knew a lot of the same geographies growing up and everything. And we've been in a lot of the same circles, know a lot of the same people. I hold this person in super high regard. And he's also done a lot of investing in things, not just multifamily. He definitely runs a very successful multifamily company. But we're going to talk about all kinds of investing vehicles, including the one that I want to just pick his brain only because it's fun, not because any of you guys should do it. And he'll tell you all about why y'all shouldn't do this. But that is investing in racehorses. We're going to talk about that and many, many other things. Let me bring in our guest of the day, Jay Scott. How are you, man?
Hey, how's it going?
Fantastic, man. How are you?
Great. Love that intro and 100% agree with you.
Yeah. This will get split out from the segment I talked about current events and everything like that. But your take, I know you and I like to joke about what the cool kids are doing, and you and I both run companies that kind of run the opposite direction of what the cool kids are doing intentionally for a lot of reasons, because we've seen, observe the masses and do the opposite, right? What are your thoughts? Like, why is New York City showing the highest rent growth? That chart that I just showed, 4.8% in New York City. What are your thoughts?
I think that, we saw a lot of the major cities lose population during COVID. A lot of people moved out. They were moving places where, in theory, it was nicer to live. A lot of people came down to my neck of the woods here in Florida. I'm sure a lot of people moved down closer to you and other parts of the Sun Belt. But at the end of the day, people lived in New York City because they loved living in New York City or San Francisco or LA or Chicago or Boston, whatever the city is. People are drawn to those sorts of, I'm not, I don't like it. But there are people that absolutely love that. And COVID made it really difficult to enjoy all those things they were enjoying for whatever reason they moved there. But now COVID's over and people are realizing I miss the city. And again, not me, but lots and lots of people. They love that city life.
Employers are also mandating that, listen, for a little bit there, it'd be fine if you work at a larger banking institution that has its headquarters in New York City. And sure, go ahead and telecommute from Honolulu. Remember that whole thing, how like Hawaii was attracting a lot of people to come and relocate to Hawaii to just, I'm air quoting, work, because that's what you're going to do if you live in Hawaii, right? To work from Hawaii or these fantastic locations. I think a lot of these companies are redacting their rules. You heard the famous Elon Musk quote, pretend to go work somewhere else, and that if you want to work from home or whatever, you can do that for another company. And I think a lot of other companies followed suit. So all of a sudden, I think the remigration to America's big cities is that companies are saying no. Either do a hybrid, which is fine. Maybe work from home Monday, Wednesday, Friday, but you got to be here. There's a certain team camaraderie and a certain necessity for being in an office and a physical presence. So I think that's changing things too.
Yeah, and so I it's funny because we kind of predicted, not that it was a major prediction or difficult to predict, but when we started to see a lot of these big cities losing population growth and seeing rent declines and value declines during COVID, our prediction was that that was going to see a recovery within a few years. And we talked
Mhm.
about investing in those places. And there are other reasons that we don't like investing in some of those big cities, just
Yes.
a lot of the landlord tenant laws, et
Yeah.
cetera.
Yeah.
Um,
Yeah.
but I think it's not unexpected that we're seeing increase in population and we're seeing rents go back up and
Remigration.
values go back up. Yeah,
No, I did segment on the show a while ago about the U-Haul report. I'm sure you read that.
yeah,
Because a lot of people were just like, yeah, I heard people go all kinds of different ways with it, Jay, right? And then this is you're like, well, you see, those are all the red states. That's where people are going. That's because they want to vote a certain way, or that's why they're migrating. Okay, number one, not true. That's not why that's happening. But people are also you see Texas. That's why Texas is amazing. That's why you should invest with us in
yep,
our. I know you have investments in Texas, but not in the cool kid cities, right? Not in Dallas and Austin, right? In the more secondary, not the Houston's the secondary city, but it's not as air quote broadcast as a primary market to invest in as Dallas is. If we could
yep.
agree on that. But if you look at that in Florida or another state that a lot of people are migrating towards, I feel like that U-Haul report got read very, very wrongly. Did you get a chance to review it? Your thoughts? It was a couple months ago, but your thoughts on the
I I
report?
I I I did, and here are a couple of thoughts. One, people were moving. Sure, maybe people were moving to places. Some people were moving to places because they had fewer COVID restrictions, et cetera, et cetera. Not discounting that there were some people that moved based on that, but I think a very large percentage of the people that relocated did it based on cost of living. Because
Hmm.
what we were seeing migration from high cost of living areas to much lower cost of living areas,
Hmm.
which makes sense when people are concerned about job security.
Yeah.
And COVID certainly gave people reason to be concerned about job security. Also, when people have their choice of where to live, when you can work from anywhere, where are you going to live? You're going to live someplace where it's cheap to
Yeah.
live, but you're still making a lot of money at whatever job you had in New York City or San Francisco. And
Yeah.
so I think cost of living played a large part. But here's the other thing, and I'm not discounting the U-Haul survey, but keep in mind that U-Haul survey was for 2023,
Hmm.
meaning starting January 1st,
Yeah.
2023 through December
Right.
31st. A whole lot has changed between
Sure
January
has.
1st,
Yeah.
2023 and today. And I think there's no better example of that than where I live. I live on the west coast of Florida, and we're
Yeah.
seeing probably the fastest softening in values, the highest increase in inventory of listings,
Mm.
drops in rents, softening of values of anywhere in the country.
Mm.
But
Yeah.
if you look at that survey, if you look at the
Yeah.
U-Haul survey, it's just the opposite because last year we saw the highest
Yeah.
increase in migration of pretty much any city in the country here in Sarasota. And
Good
so
point.
that data is out of date.
Yeah. And well, here's another reason why the data I think is very skewed. When you go rent a U-Haul, right, you're not always doing it to move your homestead, right? That's why I think the U-Haul report in its essence is bogus. Because like you and I mean, I can't imagine an alternative world where this would be the truth. But you and I could be in a rock band, right? And we could rent a U-Haul. It'd be great. Yeah, I'd be bass player. And we throw our stuff in a U-Haul and we take it around and we use the U-Haul for something that's completely having nothing to do with moving my homestead. The report was just the people that pick up a U-Haul and pick up it up from here and drop it off there. What else do people do with U-Hauls? They move their kids to college, right? That's a major migration that happens with you. My parents rented a U-Haul to take me to college and all that because they got to take all my stuff, right? There are non-homestead relocation ventures that happen. There's a bunch of colleges in Texas, so that's skewed. The data I think is skewed, right? Now, there's another report that did not get a broadcast like the U-Haul report did because the data was very different. The report that I saw, that I reviewed and compared the two, was from United Van Lines, right? If you're renting a United Van Lines or hiring them, you are moving your homestead and you're also likely not renting. You're moving the home that you own because you need a big old 18-wheeler full to fill it to the gills full of stuff and take it from one place to another. Do you care to guess what the primary state that was moved to? I might give you 50 guesses. You might get another 49, right? Do you care to guess which state was the number one state moved to under the United Van Lines report? I'll give you a hint, not Texas, not Florida.
California?
Vermont.
Vermont. That's right. I did. I saw that. I saw that a couple days ago.
Yeah.
That's right.
I saw that and I'm like, why? Listen, I get that it meets the narrative. Everything from red state, blue state to, you see, that's why Texas is going to be okay and it's not going to falter because U-Haul report. But the United Van Lines report was actually a better conversation to unpack why. Why are people going to Vermont? That's a better conversation, I think, than anything having to do with U-Haul, because you're not going to put your band or your kids' college stuff in the United Van Lines truck. You're likely going to put your homestead that you own. Again, it's not for renters. This is a home ownership thing. This is more money swinging from one place to another. So I didn't get a chance to unpack it further. The only theories I have as why Vermont was the winner there is New York City. Again, same what you had. 2023, early migration or whatever. I think that was people that said, you know what, I'm going to go and do maybe the hybrid remote work thing. I'll work from a gorgeous place like Vermont, because Vermont is beautiful. I'll work from there and then maybe commute down to the city for a couple. That's a heck of a commute. But commute to New York City for 1 or 2 days a week or every other week or whatever. Don't want my family stay up there in Vermont and have a better lifestyle, or whatever it is. Maybe there's more growing industry in Vermont than people know about. Vermont could be a sleeper investment place. I don't know if we want to unpack that one or not, but I think that's where the better conversation is, not conversations that just back up existing narratives and just say, I told you so conversations, right? That's not even worth talking about. Conversations that are like, I'm not sure why that is. What are your opinions on it, Jay? So why do you think Vermont saw so much action?
I mean,
Make it or not.
we can all guess. I mean, if you're looking at, I don't know United Van Lines. I don't know like if they rent trucks or if it's just moving. But maybe people are going for vacation. Maybe people like they don't want to buy a camper, but they buy one of those storage things that tethers to your truck, and so they can take their stuff for a 2-month vacation where they're.
United Van Lines is like Mayflower. It's like that company it's professional movers. Like it's an 18-wheeler of like guys that come up with 18-wheeler that opens up on the side. Likely when you guys moved from Maryland down to Florida, it's that kind of company. Unless you decide to do it on the cheap and rent it to U-Haul yourself. But when Liz and I moved, we hired a company like that. Like just give me, brawny guy, big linebacker size guys that can carry heavy objects and a big 18-wheeler. It's that kind of company. So interesting, but I feel like as real estate investors, the way that we uncover truths and we uncover real things that are going to matter and maybe make us an unfair advantage is to look at data like that doesn't speak to a current narrative and find ways to let's investigate that. Maybe there's some employer we don't know about. Maybe there's something happening in Vermont that's underneath the sheets for now, and Vermont might be the headline a couple of years from now, and it'd be better to get in now. So.
Well, I just did a quick search to see why people are moving to Vermont than any other state, and it's
ChatGPT.
Well, I wanted to see if there was any actual data, and there was a survey that was done why people are moving in, and it's the 3rd year in a row people are moving most to Vermont. 29% said they were moving to be closer to family. 20% said they were moving for a lifestyle change. So that's half the people are basically moving for personal reasons.
Yeah.
They're not moving for jobs. They're not moving for pandemic reasons. They're not moving for political reasons or religious reasons. It's personal.
Yeah. That's good. That's good. I think in more sense, that's why people move. The problem with Vermont is it's not like a thriving major metropolis. Burlington, Montpelier. That's a fun place to say. That you could go and hey, let's buy lots of multifamily apartment complexes there. They're different. They're kind of sub-tier markets that it's tough to do business in if you want to scale. But hey, let's go. Let's change directions here. Could you please? I know we just hopped in because you heard my current event piece, and I you and I talk enough that I love to just chat with you about things. But before we go any further, could you just do like a quick intro to our audience, to those watching, and for those that are watching the recording of this, about yourself, your business, the whole thing. Give us a rundown.
Yeah. So I am a multifamily investor today, probably best known for being a single family house flipper for a long time from 2008 to 2018. We flipped a few hundred houses. And I started in real estate back in 2008 after being in the tech industry for most of my career. I was an engineer and a business guy. And so for the last 16 years, I've been doing real estate, written a few books. A lot of you, if you're on Bigger Pockets, may know me from there. I think that's kind of where I got my name. I started on Bigger Pockets in 2008. Basically, I was looking for how to flip my first house. And so I did an internet search, got me to Bigger Pockets. I learned how to flip houses from Bigger Pockets, and I've been teaching and doing for the last 16 years.
Awesome. That's awesome. Great. Thank you. Now, before I want to get into to go another, like, with regards to where we at in the real estate market. Have Jay Skies. I've always appreciate and respect when you pull out your crystal ball, so to speak. You tell me where you think the world's going. I do feel like that you have your finger on the pulse in a lot of different ways. So I want to get to where you think the hockey puck is moving in the residential real estate space. Before we get there, you've also done a lot of other investments in other asset classes outside of real estate. I know you've done a lot of venture capital stuff. You and I have investigated venture capital ventures together, and been on joint calls, which has been interesting to see your mindset for the way you vet things. And that's so. Could you please also unpack a bit on other things that you've done? And then the last one we'll get into is, of course, the one I wanted to chat about briefly anyway, was horses. But talk to us about a bit about other investment classes outside of real estate that you found yourself in the middle of, and what you liked and why, maybe stuff that worked, stuff that didn't work out, whatever you want to touch on.
Yeah, so I think the biggest one, and I've invested in a whole lot of asset classes, if for no other reason than I like to learn about new
Yeah.
things. So there probably aren't too many asset classes that I haven't like touched on at some point in my career. But at the end of the day, real estate is my number one, and number two for me has been businesses. And when I say businesses, I don't necessarily mean starting my own businesses and actively managing my businesses, but being a passive investor in other people's businesses, what we often refer to as angel investing or venture capital,
Mm,
depending on the size of the business generally and the size of the investment. But businesses have always appealed to me because it's something that I feel like I understand. And I'm a big fan of investing in those things that you know and that you like, that you're interested in, that you feel like you have a competitive advantage. Because at the end of the day, when you're a passive investor in anything, your competitive advantage is one of two things. It's the operator that you're investing in, or your knowledge of the space to vet the investment. Because too often when we invest passively, we're just handing over our money to somebody else that we ultimately have to trust, and it can be very
mhm.
difficult to do that. Everybody likes to ask me, so I want to do this passive real estate investment or this passive business investment. How do I vet the investment? And what I tell them is you can't. It's very difficult to vet the investment. What you can do is you can vet the investor, the operator, the person you're investing with, because at the end of the day, a great operator, somebody with a great track record, is more likely to be successful than somebody who is not as great an operator, who doesn't have the same
Yeah.
track record. But what I found is with business investments, unlike with real estate, you sometimes can get an edge by underwriting the investment. You can look at the business, you can look at the product, you can look at the service, you can take it for a test drive, you can look at a beta product, or you can get a feel for, hey, is this something that I would use, and how much would I pay for it? As opposed to a real estate investment where if you're investing, Matt, in an apartment complex in Louisville, I don't know anything about Louisville, so I don't know where I'd want to live there, how much I'd want to pay. But if you were starting a business and you were creating an app that was going to allow me to better vet my brokers, or an app that was going to help me find real estate, or an app that was going to help me do whatever. If it's an app that I was planning to use, I could say, let me take a look at your product. And I can say,
Mm.
is this a good product? Is it a product I like? And so I can get a better idea of whether a business, in many cases, is going to be successful because I can get a hands-on of the product than I
Mm,
can in real estate. And so I've always liked the idea of investing in businesses. Specifically, I focus, again, because it's something I know and something I can get my head around. I like to focus on businesses in what we call the prop tech space. And prop tech stands for property technology, which imagine companies like Zillow or Airbnb, or Redfin, companies that are involved in technology but in the real estate space. And those are the businesses that I like to invest in because, again, I can look at those businesses, I can look at the product, and I can say, hey, is this a product I would use in my life? Or if not one that I would use, is this a product that my friend Matt might use or other
sure.
people I know might use? Does it actually solve the problem that it's intending to solve? And so by specializing in the type of investment where I can look at the product or the service and say, hey, that is something I would use, I can evaluate it based on my own needs for this product, I get a much better idea of whether that product's going to be successful in the marketplace, whether it has a good, what we call product market fit, whether it
Mm.
actually meets the needs of the potential customers. And if the answer is yes, and if the operator, the person running the business, starting the business, is somebody that's good, has a track record, somebody I trust, now I have two data points. Whereas in real estate, for the most part, it's that one data point, which is the operator himself.
Yeah. So let me just unpack a few things here, right? So it's really about the operator, which this it just happens to be the analogy here. It has nothing to do with horse racing, but I was at a race a couple of years ago in Keeneland, and I was like, "How do you bet?" I was with a friend of mine, and he said, "Listen, don't bet the horse, bet the jockey." Because he was like, the jockeys know more than you do. They always will. They know the course, they know the track, they know the horses. They know that that horse might have had a hard time in the training thing, or that horse hasn't eaten in 3 days, or whatever it is. And so the jockeys kind of pick the horses they want to ride, and the data on the horse is all just data, but it's really not. The jockeys always know more than you do, in that. So you got to bet the successful jockeys when you're betting a horse race. Interesting.
Yeah, and
The
keep
second,
in mind,
yeah,
jockeys only the way jockeys get paid is they take a piece of the purse of the winnings
that's
if
right.
they come in first, second, or third. So
Yeah.
they're going if they have a choice, if they're good jockeys, they're going to pick those horses that have the most chance of winning because that's the most chance of them getting paid.
I never realized that. I thought it was like a Seabiscuit kind of thing where like one jockey just knew the horse since it was like 6 months old and stayed with it its whole life. And it's nostalgic. It's like kind of glorifies it to look at it that way, but it's not true. Like the jockey that's riding the horse might decide to ride that horse that morning, you
Yep,
know, like, and it's a, yeah. And if you also you look at the docket and realize this, or whatever it is, the race ticket, whatever, the name for the thing that shows the race schedule for the day, it's the same. Like jockey Joe Smith, he's in race number one, number three, number five, number seven, or maybe even race after race after race, right?
absolutely.
Um, yeah. So I know it's interesting how these guys move around. So interesting. I also want to say that you and I were betting an opportunity, and the opportunity we were betting, the folks presenting it to us was not able to tell us who the jockey was, right? They're just like, here's a horse, and if you
And
put
this
a
was
dollar in, it
for
doesn't mean
clarification,
anything.
it was a business opportunity.
Yeah, it's not a real horse. That's right. It's a business opportunity, and they were saying, here's a business, and if you put a dollar in, you're going to get $1 million out. Like that's pretty much the premise of the presentation. Is you're going to make lots of money. Make me think of if you're a South Park fan like I am, you're about my age. You probably grew up on South Park like I did, right? There was
Absolutely.
a South Park episode, and I always think of it sometimes when I'm not clear what the plan is for something. There was these little elves, okay, in South Park, and they're going around stealing people's underwear, okay. And they would wake up in the morning and look in their drawer, be no underwear because the little elves would steal it. And they finally caught the elves, and they were like, "Guys, why are you going around stealing everybody's money?" And well, let me show you our business plan. And they showed this business plan, and it said steal underwear on one side, and there was all these lines and like scribble scrabble or whatever. On the other side was make money, right on the other side. And so the plan was steal underwear, make money, right? And the plan that you and I saw felt like a steal underwear, make money kind of plan, right? And anytime I hear a halfway vetted plan, I say to myself, and sometimes I'll say it out loud, we're just stealing underwear right here. I mean, like, maybe this works, maybe it doesn't, right? Have you heard that analogy before? I made it up, but if you're familiar with that episode, you're more than welcome to steal it.
Yeah, absolutely. People have always seen that meme, like,
Yeah.
do something is number 1, profit is number 3,
Yeah,
and in
that's
in in
it.
between is the question mark, question mark, question mark.
Well, we'll figure
And
it out. Right.
yeah.
Yeah. But that's the hard part. And then and so there it was a steal underwear make money plan, and they weren't able to tell us who the operators were,
Yeah.
and it felt like Shark Tank for Jay and I, and for that reason we're out. You know,
Yeah,
so
100%. And
yeah,
let's be clear. The first question I ask when I'm asked to invest in a business is, what's the track record? So how many other businesses have they operated? How many other businesses have they exited?
yeah,
If they've successfully exited a business before, that increases their chances of successfully exiting this business tenfold, 20-fold, a
yeah,
hundredfold, not just because, and let's be clear, for would I invest in somebody who's doing their first real estate deal? Of course not. I want somebody that's done a real estate deal before because they know how a real estate deal works. They
yeah,
understand the moving parts. Somebody that's never exited a business before, not saying they can't do it. Of course they can. Lots of people do it for the first time, but it's a whole lot harder when you don't know what that process looks like. You don't know the moving parts. Also,
yeah,
after you've successfully exited a business, it's a whole lot easier to do it a second time because you now know all the players and they know you. And so
yeah,
when you're looking for money, there are people there that are like, yeah, I know you've successfully exited a business. I'm going to invest with you. And when you're looking to sell, there are businesses that'll come up to you and say, yeah, I know you've done this before. Let's talk. I don't have to train you on the process of merging or selling or partnering or
yeah,
whatever it is. There's just a lot more likelihood of success the second or third or fourth time than there is
yeah.
the first time.
Would you invest with, this is tangenting, but I enjoy tangenting with you, right? Would you invest with someone who had gone bankrupt before in a prior business venture?
100%.
Okay.
I
Why?
would, because unlike with real estate, where with real estate, you generally look for low variance. You want people that have done well deal after deal after deal. Not every deal is going to do
Yeah.
perfectly. Not every deal is going to be a home run. But in real estate, you can generally avoid having huge losses.
Yeah.
And so it's basically the slow and steady in real estate. With businesses, it's a lot more high variance. A lot of businesses, 60, 70, 80, 90% of businesses are going to fail.
Yeah.
And those 10 or 20%, I mean, if you're investing in businesses, if you're angel investing or venture capital investing, you don't just invest in one business. You have to
Mm.
build a portfolio of businesses and hope that your winners cancel out your losers. Unlike in real estate, where one investment should, in theory, be able to hold its own, in business, you really need that variance, that diversity of your portfolio, so that the winners cancel out the losers.
Yep.
And a bankruptcy in a business is just a loser. And over the course of somebody's career, they're hopefully going to have some losers, because nobody, I mean, and when I say nobody, very few people. I mean, you can look at a Bill Gates or a Warren Buffett or an Elon Musk. Yeah, their first venture did so well that they had enough money that they could capitalize any future venture without having to worry about it. But for most of us mere mortals, um, a bankruptcy or a failure in a business is not uncommon. The question is, did they learn from it and can they do better the second, third, and fourth time? So if somebody's going to have a bankruptcy in a business, for me, that is absolutely not a disqualifier. Now, let me point out, I've started a business before where we didn't do a bankruptcy because we had all our own capital in there, but I lost a lot of my personal capital.
Hmm.
And so that to me is, yeah, I chalk that up to failures are good if we learn from them and we don't make those same mistakes moving forward.
Yeah, absolutely. And it's if I was talking to somebody who went bankrupt, I'd say, in a business, I'd want to hear more. It's almost a curiosity
Yeah.
standpoint. Like, man, that you must have had a great idea that didn't. Maybe your timing was off. Maybe you had an idea for the next Uber, but you didn't break. But you had it on the market in 1985, and we didn't have all the tech to support it, right? Maybe you're just, yeah. So maybe your idea was off on timing. Maybe you weren't undercapitalized. Maybe whatever it is. But more importantly, what did you learn from that,
Yep.
and how are you going to take the lessons, the contacts, those kinds of things, and leverage them forward? So,
Yeah. And the other question I ask is, how much money did you lose personally?
no,
Because if somebody lost a decent amount of money, like the last business that I started that failed, I lost about $300,000 of my own capital,
yeah,
and that should tell somebody, if I'm going to start another business, I now understand what the risk is. I now understand that like I'm putting a bunch of capital at risk and there's a really chance of losing it. I'm not going in with rose-colored glasses and telling my investors, "Hey, I'm positive we're all going to make millions of dollars here." I'm going in with the attitude, I know this can fail, but I am confident enough in this venture,
Yeah.
knowing that I could still lose hundreds of thousands of dollars, that I'm willing to try again. And that says a lot.
It does. It says a ton. I've met a few people that got up and dusted themselves off and got back in the ring, man. And I've had to do that many, many times in my career. I'm sure you have too. Actually,
Yeah.
know you have too. In that. So, Douster Group wanted to just throw out there. I know there's a typo here, but tell us briefly about the build outs and exits you've had, Jay. And I know you've transitioned and pivoted, and I know you've had exits, but just if you want to highlight any build-ups or exits you've had in your career as an operator, or maybe even as an investor and investing in something that built up and had an exit. So give me the LPGP comparisons on your full cycle projects.
Yeah. So as a GP, most of the businesses, most of the projects that I've done in my life have been in real estate.
Yeah.
That said, I got very fortunate early on in my tech career, or I guess late in my tech career, but earlier in my career, I uh, took a job, a pretty senior role with a company back in 2006 that ultimately got purchased by Microsoft a few years later. And I was involved in some of the merger role in that job. So I got to see from the inside how like $1 billion merger takes place and how it works. And so that was a successful exit. Was not a company I started, but was a company that I was significantly involved in as a senior person. And then I as a GP as a partner, I bought into a company a few years ago that I grew a decent amount over a couple years, and then sold my share in that company. So did have an exit there, but most of the stuff that I do outside of real estate is as an LP,
Hmm.
and
Yeah.
that's because I'm a fan of focusing. I like
Yeah.
to put my time and my energy into that one thing that I'm really good at, and for me at this point in my life, that is being a real estate investor, and so that's where I spend most of my time. Now that said, I do have this thing where if I'm going to invest in a business, especially a business in the real estate world, prop tech business, a lot of times I will ask to be on the board of advisors or the board of directors. I want an active role in the company because if I'm putting my money into the business, that gives me the ability to have some operational impact on the business. So
Makes sense.
yeah, I can see what's going on. They have the ability to leverage my knowledge and expertise and network. And so for a lot of the businesses that I invest in, I also sit on the board, either advisors or board of directors.
And you bring
Um,
value, right? It's not like you're sitting on the board of a basket weaving company or whatever. You're sitting on the board of a company that has, a trajectory that you've had some exposure to. So it makes sense.
Exactly. And one
That's
of the benefits there is it generally results in getting additional equity in that company. So
yeah,
if you find a company,
yeah,
and I tell people a lot, if you're really good at something, and again, a lot of people listening to this may be really good at real estate, go find a business that is focused on that part of real estate, like not a real estate business, but an actual business, a tech business maybe, that's focused on something you do. If you think you can add value, go talk to the founders of that company and see if there's a role for you as an advisor in the company
hmm
and potentially get paid for doing that role. That gives you some credibility. That gives you some stature in the industry, and it also gives you some additional equity in a company related to what you're doing. And so
yeah,
I know plenty of people that have made a lot of money simply by being advisors to companies that have been very successful.
yeah. That's brilliant. That's brilliant. Now I got to pivot here. Let's have a little bit of fun here. Somehow or another, you either stumbled or intentionally worked your way into owning racehorses.
Yeah.
And I lost the inside the inside shout out originally, but somehow or another I was watching. Yeah, I was on an airplane a week and a half ago, and one of the Lord of the Rings movies was there, so I thought I'd throw it in, right? And they started talking about Helm's Deep, about one of the places that in the Lord of the Rings. I'm like, that name, I've seen that name, you know. And then I go back and when I'm recently doing a little bit of research before I interview today, I saw that's the name of your horse is Holmes Deep. So you doing like little like J.R. Tolkien, you probably grew up on the Lord of the Rings franchise, as a lot of folks did. So you had Helm's Deep, your horse. Tell us a bit about how you got your way into horse racing. How did this happen? Intentionally, unintentionally.
Yeah, so I've been a fan of horse racing since I was a kid. You and I grew up not too far
Great.
from each other. I grew up walking distance to Pimlico Racecourse in
Yeah,
Baltimore,
me
which
too.
is
Me
the
too.
home of the Preakness.
Yeah.
I used to on the weekends. Not that I never skipped school, of course, but on the weekends, my friends and I would go to the race course and watch the horse races. Every year during Preakness, we'd go to Preakness and sit on the infield, and so I was always enthralled with horse racing. I liked the math part of it. My friends were degenerate gamblers. I was
Yeah.
just like I love trying to figure out the math and the odds and seeing if we could get like some advantage over the odds makers in
And
certain
hack the odds.
situations
Right.
and hack
Yeah.
the odds. And
Yeah.
I was never tremendously successful at it, but I loved it. And so I
Yeah.
used to love going to horse races. 2017ish, my kids were in elementary school, and they had some friends, and we met the parents of one of their friends, and the dad was he's a tech guy as well, and I found out that he owns racehorses,
Hmm.
and I always thought, wow, what like how do you just own racehorses? That's
Yeah.
crazy. And so he started to explain the process to me, and I just mentioned off the cuff, well, if you're ever looking to invest in a new racehorse, let me know. I'd love to like come in and partner with you.
Yeah.
And a couple months later, he calls me up. He goes, "You want to buy a racehorse?" I was like, "Really?"
Yeah.
He said, "Yep. Here's what you need to do, and it's basically wire me some money." And I said, "Okay, let's take a chance, so just a leap of faith."
Right.
And I bought a racehorse with him, and I got pretty involved in the process of owning the racehorse and watching the horse race. And then he wanted to buy another horse, and so we bought another horse. And then he wanted to buy another horse, and we bought another horse. And then he was like,
Here we
let's
go.
put together a partnership. I have some other friends that want to buy horses as well." And I said, "Okay, I know how to manage partnerships. I know how to manage syndications. Let's formalize this." And we created a joint venture. And now there are five of us who invest in the joint venture. We own 14 horses. And we've got horses pretty much all over the country running races
Yeah.
at various tracks. And the sad thing is, I used to live in Maryland, and I wasn't too far from Laurel Racetrack and Pimlico
Yeah.
Racetrack, and that's where a lot of our horses were, which was great. The kids and I could go visit the horses on the weekends, and
That's my horse, son. You
that's
know.
my horse. And literally, like, we got to know the horses, and the horses got to know us. And we could be behind the scenes, like in the paddock when they're getting ready to race. If they won, we'd be in the winner's circle. We knew all the jockeys, we knew all the trainers, a lot of the big names in the horse world we've gotten to know. So it's been pretty cool. And so I can talk about the good and the bad of horse racing, but we're pretty well invested in it now. We've won a couple big races. We've had our share of setbacks as well. And so yeah.
Helm's Deep ran at Preakness?
So Helm's Deep ran the race right before Preakness. So Preakness
Okay.
was race 12 or 13.
Yeah.
Helm's Deep ran in a stakes race, the race immediately preceding it.
How did it
And
go?
it was
How
pretty,
did he do?
uh,
Gee.
he did not do well. Well,
Huh.
I shouldn't say that. If you look at the results, he did not do well, but he was leading the field for like the first 80% of the race. But he was an underdog. It was a long distance for him. We didn't expect that he could keep that pace the whole race, but we told the
Were
jockey
you just
basically,
heart in your throat the whole time when he was in the lead 80% of the time, or just please hang in there, buddy? Like what?
sort of, except that we know the sport well enough, and we know our horses well enough, that we knew that
Yeah.
that was the most likely outcome, that he was going to lead the race for the first 80, because we talked to the jockey beforehand, and you strategize. Like, just like for any investment you make, for any deal you do, you have a business plan. And the business plan on this one was the horse was going to run hard for the beginning of the race to get a lead, and hope that the horse could maintain that lead and have enough energy to finish out the race. Though we knew that the pace that that horse we were going to put him on would probably tire at around 75 or 80% of the race.
You knew it.
And
You
that's
knew, you
and that's
just figured
exactly what happened.
let him go sprint out, and maybe
Exactly.
he maintains it. And that's
Exactly.
just how that horse is. He's a sprinter. Okay.
Yep. Yep.
Um, yeah. Huh. That's interesting.
And so
Um,
it was an exciting race.
yeah. Do you recommend? I've talked to you about this before. Is there a way to make like reasonable returns on horse racing? Is it something or horse ownership? Is it something that you figured out a way to create some sort of a passive income from, or is it something where it's just a more of a hobby than anything else? I mean, where are you at with it, and what do you recommend for people that have the itch as you did?
Yeah, so let's talk about in general what horse racing involves, or owning horses or race horses involves. I actually like to use real estate as a good analogy for race
Yeah.
horses. So there are a few different ways to invest in real estate. You can develop it. I mean, you can build ground up. You can do what's called value add, which means you buy a distressed asset, like a rundown house or a distressed apartment complex, and you add value, you renovate it, you improve management, and you increase the value. Or third, you can buy what's called a stabilized asset. Basically, you're buying a house that's perfectly good, or an apartment complex that's perfectly good, and you're just generating cash flow from it month after month. And you can do the same exact thing in horse racing. On the most common thing to do is what we call the value add model, which is you buy a horse that you think you can improve. You can train it better, you can feed it better, you can house it better, you can treat it better, you can give it better veterinary care,
Hmm.
and you can improve how fast the horse runs or how consistently the horse runs. So it very much is the similar. It's similar to buying a flip property or an under valued apartment complex. You're buying a horse with the intent of making it a better racing horse and making money from its racing.
Hmm.
Number two, you can buy a horse and you can breed it. So you can have that horse basically produce foals, baby horses, that you then keep for a couple years and you start racing it. So that's the equivalent of new construction. And then third, you can buy a horse that's already a good racing horse that's winning consistently, where you know if you pay a reasonable amount for it, it's just going to keep running every 2 or 3 or 4 weeks, and you're just going to generate a little bit of cash flow from the horse winning races every few weeks or every few months. And
Yeah.
so we tend to focus on the value add. We buy horses either at auction, or horses out of other races. Um, where we think that horse could perform better. We have the ability to make that horse a better racehorse. And so we'll buy that horse, we'll put it into, we'll train it. We have a trainer or a couple trainers that work with the horses. We'll put them into harder races that generate higher paydays. And if we can successfully make them better racehorses and they can win more races or higher priced races, we make money. And so we
Hmm.
do very much what we do in the real estate world, but with horses.
Hmm. Yeah. Interesting. Interesting. Is it a investment for the faint of heart, or is it something that you think is scalable, or is it for fun or for cash flow for making money? Which one would you recommend for people that are even thinking about it right
Yeah, let me start with, I talked earlier about real estate is more, you can make a single investment and you'll probably do pretty well because there's low variance on the results in real estate. Business investments, you're going to have 90% failure rate, and you hope that the 10% is so successful that it wipes out the losses from the 90%. Horse racing is somewhere in between.
now?
Every horse you buy is not going to be successful. You can't just buy one horse. I mean, you can, but it's unlikely you're going to buy one horse and make lots of money. It has to be a portfolio play. You have to buy a bunch of horses, but you're not going to have a 90% failure rate. Most horses are basically going to break even. The
Hmm.
amount you're spending every month to feed them, to house them, to train them, to take care of them, their veterinary costs, to transport them to races and back and forth from the barn to the races, all of that, most horses you're about going to break even with the amount of money that they make. And your
Yeah.
hope is that you have one or two horses that go on to run really big races and make a lot of money, and they will cancel out the horses that do
right.
worse than average, where they're not even
They'll win
breaking
a few
even.
purses here and there, and those revenues wash out the maintenance costs of the other horses, and then maybe you get one that just breaks out.
Exactly. And
Yeah,
so I would say that most people that own racehorses are somewhere around break even.
yeah,
They're losing 5%. They're winning 5% of their
yeah,
investment every year, but they're not doing tremendously well or tremendously poorly. And they do
yeah,
it because they love it. They do it
yeah.
because they love horses. They love being involved in the sport. They love being able to see the horse before the race and going to visit the horse in between races. My kids used to love going to visit the horses. And so I think that's why most people do it. And I think that's the best reason to do it. Now, there's certainly the elite horse owners that own the horses, the $1 million horses, the $5 million horses, the $10 million horses, the ones you see running in Preakness and running in the Kentucky Derby, where they are stacking the odds in their favor by owning really expensive horses.
Yeah.
Basically, the monthly cost for a horse is going to be pretty much the same,
Mm,
regardless of whether you buy a $10,000 horse or a $10 million horse. The cost to house it, to feed it, to train it, to take care of it is going to be
yeah.
about the same. But that $10 million horse is going to be running much bigger races and winning much bigger purses. If you buy a really inexpensive horse, it's really hard to overcome just the expenses in the races that it's going to be running, even if it wins those races.
Same
Winning a
with your
five
real
thousand
estate.
dollar race once a month when your expenses are $5,000 a month
Yeah.
just isn't long term. So what I tell most people is, no, horse racing is not great from an investment standpoint. If you're looking to round out your portfolio with a good investment, horse racing isn't it. But if you love the sport, if you love horses, if you would enjoy going to be able to visit the horses and watch the races and be in the winner's circle, then yeah, there's opportunity to invest with other people, to invest through syndications, and really be involved in the sport without being hands on.
Yeah, yeah. I would think that like the big money is also the big risk in that like to make the real estate analogy, I'm going to go build an apartment building in the center of downtown Austin or downtown Charlotte or whatever it is. That is like I know there's high need. I know there's a lot of money to be made. It's a low cap, high barrier to entry market, whatever you want to say. And so that would be he probably trying to breed a horse that maybe would one day win the Kentucky Derby or something like
Yep.
that. That's probably the biggest maybe smack out of the park thing, but you'd also could certainly swing and miss because you could breed the wrong horse or have a horse that didn't quite work out or whatever. Love your analogy on to comparing it to real estate with regards to fix and flips, rentals, drawn up development, those kinds of things. So good stuff. Before I want to get into the real estate thing a little bit because you and I have many conversations over the years. When I was in the drunk real estate show with you, then that was make sure we give people a plug for that as well to check out your podcast because it's a great show, a really unique concept that you guys are doing there. But on that, I really enjoyed our conversations talking with you about where the future is, where you think things going. So where do you think multifamily? That's been our core investment for both of our companies. For Bar Down Investments is your company, and for Durosa is the company that we're on over here. What are you guys seeing in today's multifamily market? Where do you think the hockey puck's going the next couple months? Like, give me your tea leaf crystal ball prediction for where we at, where you see multifamily the next couple months.
Oh, next couple months is tough.
Yeah,
Um,
or
let, let, let's
next whatever, however far you want to go.
Yeah, let's start further out, and then we can move back in.
Yeah, yeah,
I think long term. I mean, I'm still we're still buying multifamily. You're still buying
mhm,
multifamily. There's a
yeah,
reason why we're still buying multifamily, and that's because historically, multifamily real estate has provided the best risk-adjusted returns of pretty much any asset class on the planet. So if you compare the returns to the perceived risks, investors' perceived risks, and actual risks for investment, multifamily real estate is literally one of the, if not the single best investment on the planet over the last 50, 60, 70 years. So
yeah,
that's the reason why we're in multifamily. In terms of the future, well, I think there are a lot of trends that are basically tailwinds. They're in our favor. They're pushing the industry forward. Number one, we're about 5.5, 6 million units underserved in this country. Basically, there's just not enough inventory for all the people that are moving into the country, whether it's immigration, whether it's natural population growth, just people being born, family formation, so people getting married, moving out of their parents' house or moving out of college and needing a house. We need about 5.5 or 6 million more units in this country
Mhm.
than we have. And so anytime you have constrained supply, you're going to see higher prices. And so we're going to see prices go up, values go up,
Yeah.
rents go up over the next several years. So that's number one. Number two, we're not seeing a lot of building. This year, we have a lot of inventory coming online, but 2025, 2026, we don't see a lot of what are called housing starts, meaning we don't
Yeah.
see a lot of new construction starting. Most new construction takes 18 to 24 months between the time they start building it and the time it comes online. So if they're not building anything today, if they're not starting anything today, it's unlikely in 2025 we're going to see a lot of new inventory, or 2026 we're going to see a lot of new inventory. We're not going to start seeing a lot of new inventory until 18 to 24 months after they start building a whole lot more.
Mhm.
And so while we are seeing a lot of inventory that's going to hit this year, we're not going to see a lot next year or the year after. So I suspect that 2025, 2026 are going to be good years for those who own multifamily real estate, existing multifamily real estate, because we're not going to see a lot of new competition coming into the space. Um, Next thing I'll say is the new construction that is coming into the space, because it is so expensive to buy land right now, because it's so expensive to build right now, labor, material costs, it's pretty much impossible to build anything other than Class A
Yeah.
inventory. So anybody that is building right now is building Class A. So for anybody that owns Class B or Class C, you're not going to see a lot of inventory coming on the market even this year. When we see a lot of inventory coming on this year, it's not going to be Class B or Class C, because you can't really build Class B or Class C inventory anymore.
No.
And so I think there's going to be a lot of continued demand and mitigated supply in Class B and C even this year, and then a whole lot less demand, a whole lot less supply over the next couple of years. So everything is basically tailwinds for multifamily. Additionally, it's likely that the next move by the Fed is going to be down in terms of interest rates. We're likely
Fingers
to see
crossed.
lower interest rates. Yeah, it may be a while before we see much lower interest rates, but I think it's unlikely we're going to see much higher interest rates at this point, especially after this past week where we saw a really good inflation print, basically no inflation in the month of May.
Mhm.
Maybe a blip, maybe a long-term trend, we don't know, but still good. So I think it is likely that the next move that the Fed makes will be a rate cut, which will be good for interest rates, mortgage rates, and cap rates.
Yeah.
Remember, a lot of the things that are impacting value today is the fact that cap rates went up, and when
Yeah.
interest rates start to drop, I suspect cap rates will as well.
It'll open it up. Yeah. And to follow it up for anybody watching, or for those of you talk to, what's the guidance that you give to rising multifamily operators on how to navigate today's marketplace? As you know, rates are high. Air quote, tough to find deals. I mean, listen, at the end of the day, show me a market that it was easy to find deals, and I'll show you
Yeah,
a market that was probably no financing available. That was 2008, 9, 10, as you remember. Deals were falling off the trees, but you couldn't get bank financing on them, right?
yeah,
So nobody should ever pray for 2008, 9, 10 to happen again, right? Because I was around, you were around too. That's not a time that you should hope returns. But aside from that, what guidance do you give to people that are looking to stay active, looking to grow in today's marketplace, given what's going on?
yeah. Well, just to address what you just said, keep in mind it's never going to be a great time to both buy and sell.
Yeah,
Sometimes it's going to be a great time to buy and a horrible time to sell. That was
it's never going to be
2008.
an easy market. It's
Yeah,
just that's the thing. It's going to be hard one way or another. You can't you can't hope and pray for easy times. It's not going to happen. You know,
exactly,
um,
exactly.
yeah,
But anybody that's looking to get in today, I suspect, and this goes, let me answer your question about the next few months. I suspect the next few months we're going to start to see a lot more inventory hit the market. Basically, what we've seen over the last couple of years is there are a lot of operators out there who have been hit by these higher interest rates. They've been trying to kind of stay afloat for long enough that interest rates start to go down, mortgage rates go down, rate cap prices go down, and they were hoping that it was going to be this year because everybody was talking 2024 is when all the good things are going to happen. Interest rates are going to go down and mortgage rates are going to go
The
down.
three rate drops this year, right?
Yeah,
Yeah, yeah.
exactly. And so I think there are a lot of
Everybody's taking that for gospel. Well, they're just saying that right now, guys. They don't really mean that. That's just what they think. But people took that for granted as a fact that that's what
yeah.
was going to happen. Hasn't happened yet, but yeah, keep going. What other thoughts would you give
Yeah.
somebody who wants to get in?
Yeah, and so there are a lot of operators who were hoping and praying and expecting that 2024 was going to be the perfect year to refinance or to sell and
Yeah,
make lots of money. But I think what they're starting to realize is 2024 isn't going to be that amazing
mhm,
opportunity that we were all hoping. And I think there are plenty of operators out there that are starting to get more strapped. They're getting into the position where they can't push things out much further,
yeah,
or they don't want to push things out much further. They're exhausted. They don't feel like struggling. They don't feel like fighting. And so I have a feeling there are going to be operators out there who are going to say, yeah, investors, I'm not going to get you your 15 IRR, your 16 IRR, like I was promising you. I'm just selling this thing. I'm going to get you your preferred return, your 8%, your 7%, your 9%, whatever it is, and we'll live to fight another day. And
yeah,
so I expect that there are a lot of tired operators right now who will likely cut bait and sell their properties for a reasonable valuation, maybe make
yeah,
a small profit. And so for us as buyers, I think there's going to be a lot more inventory hitting the market over the next few months, and we'll have the opportunity to pick up some decent deals. What I would suggest to anybody out there that's looking to buy, one, you have to ask yourself the question: do you have investors, or are you just investing your own money?
yeah,
Certainly, if you're investing your own money, you have the ability to be a little bit more aggressive, to take more chances. For stuff where I'm investing my own money, not my investors' money, we're being a little bit more aggressive. I'm confident that the market is going to improve over the next 5 years, which is the typical hold period for multifamily. So I'm willing to be a little bit more aggressive with my capital, knowing that investing today, it's not the perfect time to own multifamily real estate. But in 5 years, I think things are going to be really good, and anything I buy today is going to be worth a lot. For my investors' capital, anything I'm steering my investors into, obviously I want to be more conservative. Just telling them that everything is going to be great in 5 years, don't worry, give me lots of money, isn't going to appease them. It's not going to convince them to invest. So what we need to do is we need to be real conservative in our underwriting. We need to underwrite conservative rent growth, even
hmm
though I think after a year or two from now we're going to see normal rent growth again. We need to underwrite high expense growth
yeah,
because labor, materials, insurance, property taxes, everything's going up a lot. Inflation still exists, even though in a couple of years I think inflation is going to be back down, and we'll get the benefit of lower expense rates. We need to be conservative on the exit cap rates. So right now you might be at 6% cap rate in your market. Investors want to hear that you think you're going to exit at 6.5. In reality, I think it's unlikely we're going to see another half point expansion in cap rates. But if you can get a deal to work at 6.5, and then in 5 years we have exit cap rates still at 6, or better yet, have gone down to 5.5, all that is free money. It's bonus.
yeah,
Um, so underwrite tremendously conservatively. You're going to have to underwrite a lot of deals to find the good ones, but the good ones will be out there over the next few months or year. And know that if you're underwriting conservatively and you're finding deals today, there's a reasonable chance they're going to outperform over the next 5 or 7 years.
yeah, yeah, yeah. That's brilliant. And if rates go down, it just puts more money in your pocket, right? I would add on everything you just said. Brilliant. And we are starting to see at DeRosa, we're starting to see a few under the sheet distressed deals come on. They're certainly not mass marketed, where people think this is going to happen. It's not. Like a broker's going to just go and break out a megaphone and say, "Hey, I've got a distressed deal over here, 60% occupancy. You can buy it for pennies on the dollar. So a seller will hold financing for you, no problem. You don't need to even apply for a loan. It'll all be on a silver platter." Guys, not going to happen. The distressed deals that I've seen have been off the market. They've
Yep.
been like owners sending me direct Facebook messages. You're like, "Hey, I know you own in this market, or I see you guys own in that market. Are you guys interested in property?" Because of course they're not gonna say they're distressed, but the math starts to show like they are. The advice I've given people myself is you got to be market first, more than ever. You can't be just shopping LoopNet, waiting on seeing a 9% cap rate deal. You might find them, but everybody else sees that too. you really want to do well in this industry more than ever is the time to be down, like really, really like drill into markets. You get to know every broker in a market, every property manager in a market. Maybe even you want to play the big game, every owner in a market.
Yep.
If you've got software like CoStar, you can really start researching owners, looking to see what their debt is on properties and stuff like that. You do that level of research and that level of market infiltration, you will know before anybody else does when good deals start to come on. If you go wide, you're going to miss a lot of these things. Going deep into a market is the only way I think that you're going to catch these fire sale off the market things that are going to be on the market for like a minute or two. You know,
Yep.
these things will be on the market where the broker might say, hey, I need your best offer. This thing has to close in 45 days, no retrades, no extensions. This guy's rate cap is coming due or his debt's coming due, whatever it is, and they have to sell right now. And here's the bottom dollar number. Don't mess with it. That's the phone call you may get if you are market focused. If you're not, you're gonna hear like, hey, do you guys hear about the deal that Jay Scott got? Like him and Ashley got this deal where they bought it for 50% of what the seller bought it for 3 years ago. That's how they got that deal, was by being market focused.
Yep.
Not because they got lucky, you know?
Yep. And
Yeah.
let me point out, because I know there are a lot of people out there that want to make a lot of money quick in real estate. They want to get rich quick. And the nice thing about real estate is you can absolutely get rich, but it's not going to be quick. And this is the what you just said is like the best lesson out there. The reason why brokers are calling you, Matt, and Ashley and me in our markets is because we've been talking to those brokers for 6 months or a year, or in
Yeah.
my case is probably 4 or 5 years. And those
Yeah.
brokers know us, they trust us, they know we can perform. Um, and they know that we haven't gone away. We haven't just called them up and said, "Hey, I'm looking for deals," and then 2 months from now we're like, "Oh, okay, I'll
Right.
move on to a new market or a new
Because you were
business."
shopping Houston one week and then you decided to move it over to, whatever, Miami the next week or whatever it was.
Eh,
Because many rising operators that I see tend to have FOMO, right? What they'll do is they'll decide, you know what, man, that's it. Albuquerque, New Mexico. I live there. It's the market I want to be. I've got researched my data. That's it. Then they go and listen to a podcast and they hear you talking about Houston. Like, you know what? Yeah, Houston. I'm going to do that. And then they listen to another podcast and they hear me talking about North Carolina or Greensboro, whatever. Yeah, you know what? Matt must know what he's doing. I'm going to go there. And you don't give
and then they hear
time.
this podcast and decide, "I'm going to invest in businesses and racehorses instead."
Right. That's it. Right. And then another one starts talking about Bitcoin, right? You don't give time, whatever plan you got. And here's like the real, like, take it home. Whatever plan you have could be a great one. It's not like you pick one market and that's the only way to like financial freedom by picking the right market. I don't think that's the truth. If you pick a market, great. As long as you're not picking a market that's on the downturn or whatever, if you do real homework and pick a good market that has good fundamentals, you're going to be fine. All you got to do is do the big F word that nobody wants to talk about, which is focus, right?
Yep.
Just pick the market. That's it. And have enough courage to not chase the shiny objects when they show up and stick to whatever it is. If it's Albuquerque, great. Stick to Albuquerque for the next 9 months. As I said, get to know everybody, get to know the inside tracks, and you'll be the one that gets the phone call on the 50% below market value deal or whatever it is.
100%.
Yeah. Doctor, who's been really grateful you're sitting here watching this whole show. Appreciate you. Um, Perception is 10 to 12% IRR. I get it. I don't know. I mean, Jay, I'll even change this to a maybe more broad question. Have you guys changed what your desired IRR is for deals given the change in the market? Are you still shooting for where people were a couple of years ago, which was, most people will talk 15-ish IRR was where you needed to be. Did you guys change that, or are you still targeting that, or have you changed your investor expectations for deals?
Let me start by saying a lot of people are looking at the market now and saying the market is crap. If I invest now, I'm going to see lower returns than I used to. I think that's thinking about things a little bit backwards. The fact that the market is crap right now means that the market is crap for deals that we already own.
Yeah.
Deals that we bought 2 years ago, 3 years ago, 4 years ago, where we thought we were going to make 16 or 17 or 18% IRR, those are the ones that I think are likely to take a hit, where we only make our 12 or 13 or 14% IRR. Maybe if we wait long enough, we make it all back up. But it's the deals that we bought a couple years ago that are being impacted by today's market. Today's market it's a buy low, sell high scenario, where today we have the ability, or at least in the very near future, to buy low. And so those 10 or 12% IRRs, I expect that for deals that we buy today and we hold for 3, 5, 7, 10 years, are actually going to do very well again. And so I know you're thinking the market's bad, which means anything you invest in today is going to do poorly. But the market is down. And it's like, think of the stock market. When you buy a stock that has just dropped 30% in value, the reason you're buying it is because you see that upside, because you realize that it's already dropped in value. You're hopefully buying low and can sell high at a future date. You should be more concerned if you bought that stock a year ago before it dropped 30% in value. And so, I think the 10 to 12% IRR is still low. We are targeting, when I started in this business in 2019, I think we were all looking at 16% IRR as kind of the target. Then we moved to 15%, and now we're at about 14%, which I think is a good bit more realistic. I think we saw outsized returns for a number of years because the market was so hot between 2014 and 2022. But I think 14% is kind of that right number, and we're still targeting that number. And I'm confident that if we find deals that pencil today, that we'll actually see those returns, if not better, in again 3, 5, 7 years, because I do believe the market's going to improve. But if you're in a deal that you bought a couple of years ago, you may have to wait a few years to hit the projected returns.
And you might not make, because to your point, that there were very aggressive returns because, like, hey, rent growth's off the charts, interest rates are low, cap rates are low, and there are those that are less, call it like less conservative than your teams or my teams are, right? That might have said, this party's got to keep going, right? No problem. I'll buy a property in 2021, 2022. It's going to blow out and make 25% IRR. And you've seen these things advertised, as you and I both have seen. Like, they're just assuming that things got to continue. That is quote the way that they have. Those are the deals.
And here's the problem: is that too many operators, not a lot, but there are definitely operators out there that operate on that attitude I was saying about investing in businesses, where you just invest in a whole bunch of them and you hope your winners outpace your losers. We saw a lot of operators doing that in real estate because, from their perspective, from the operator perspective, if you invest in 20 or 30 properties, and we've seen multifamily people that have invested in 20, 30, 40 deals over the last 5, 10 years, they don't care if a couple of them fail, because if 38 out of 40 do well, they're going to make a ton of money. If 35 out of 40 do well, if 30 out of 40 do well, they're going to make a ton of money. The problem is a lot of their investors aren't invested in 30 or 40 deals. Some of their investors are invested in one deal. And if that happens to be the 1 or 2 or 3 deals that go south, well, you've now basically potentially destroyed the financial situation of one of your investors. And so I don't like those operators that kind of treat this as a portfolio play, buy lots of deals, hope some of them do well, even though they know some of them won't. You really got to, if you're going to do right by your investors, you have to treat every deal individually, and every deal needs to stand on its own and be successful on its own.
Well, we could do another full show talking about what not to do or how to vet operators. Maybe that comes up through more work that you and I are doing through Bigger Pockets as new initiatives of not to let the cat out, but do stuff on the way for those that are passive investors.
Absolutely.
And that, but there's ways to vet good operators, and to just one comment is you can certainly sniff an operator that's out there doing it for the acquisition fee. Versus operators that are out there doing it for the long-term growth of the asset, the long-term brand, and everything like that. So, well, guys, listen, this has been probably one of the longest Cost Food Digest shows. I want to model maybe after the Drunk Real Estate Show, where you guys just get in there and talk it out till it's done getting talked out, right? Just an hour, couple-hour program if it needs to be, right? So
we're doing this because we love it, right?
Yeah,
I like talking to you, Matt. Hopefully people are enjoying it, but I'm doing it just because I like talking to you.
I know, right? We just talk shop, right? That's a good podcast. It just sounds like you guys sitting down having coffee or having a whatever, right? For your show. Well, listen, how do people that want to find out more about yourself, about horse racing, or about bar down investments, or anything else that you guys want to talk about? How do people get in contact with you?
Yeah, jscott.com, JSCOTT.com, and that'll link you out to everywhere that you might wanna find out about.
jscott.com. You can hear all kinds of great stuff that Jay Scott's up to, including the phenomenal work that Bar Down Investments is doing in the real estate world of all things there. So, Jay, always great to talk to you in general. So I was looking forward to having you on the show for a long time. We'll have to talk about other things next time we have Jay on the show. I'm going to just drop a
Anytime.
hint here. Not every real estate investor can say that they played in the World Series of Poker. Jay can. So we're going to talk about poker, talk about maybe how poker relates to real estate investing, all those kinds of things next time we have Jay on the Cash Flow Digest. Jay, thanks for joining us today.
Thanks, Matt.
Cool. And stick around for a second. Stick around in the green room. We'll chat one-on-one for a minute. Guys, great show. As always, as you guys can tell, Jay and I are good friends. We love talking shop about this kind of thing. Make sure you vet your operators before you get into deals and do lots of research. Obviously, make your own decisions on things, but Jay and I certainly have our opinions on what we think things are going to go. Love hearing about horse racing as well. I'd love to hear your comments on today's episode, so make sure you leave those comments down below. And if you guys like what we do here, make sure you subscribe to the YouTube channel you guys watch this on, or subscribe to the show on Spotify. Give it a good review there. I'd love to hear that as well. Guys, thank you for watching the Cash Flow Digest. The DeRosa team will be running the show for the next couple of weeks as I'm out and about doing all kinds of other fun things, but I'll be back in a couple of weeks for you guys as your host then. Thank you for watching. I appreciate your eyeballs as always. I'm grateful for you, and have a great, great weekend for those watching live. Take care.